Welcome to this comprehensive guide on paying taxes related to stocks, specifically for employees dealing with company stock compensations, like restricted stock units or RSUs. Understanding these tax implications is crucial to ensure compliance and avoid any penalties. Here's what we'll cover in today's video: an overview of RSU taxation, how vested shares are taxed, tax implications during a company sale, the importance of making estimated tax payments, the value of seeking professional advice, and key considerations for managing your tax responsibilities effectively. Restricted stock units, or RSUs, are initially not taxed when granted. However, they become taxable as ordinary income at the time they vest, which means when you have the unconditional right to own them. It's important to note that this applies even if the vesting is accelerated due to company acquisitions. Typically, your employer will withhold taxes from the cash equivalent of your RSUs. When it comes to shares that you purchased and held before the sale, the taxation can vary. Once you sell these shares, you will be subject to capital gains tax. The tax rate is contingent on how long you held them. If it's less than a year, they count as short-term gains and are taxed at your ordinary income rate. However, long-term gains, held for over a year, have a preferential lower tax rate. In the event of a company sale, where RSUs and vested shares are converted into cash, the tax implications typically remain constant. However, the timing and method of taxation could alter. For example, the company might withhold taxes on the vested RSUs before dispersing funds. For shares that have already vested, you might need to make estimated tax payments to stay clear of penalties. When your brokerage firm does not withhold taxes from the sale of your vested shares, the responsibility for making estimated tax payments falls on you. The exact amount depends on your overall income, which includes the RSU payout and any capital gains. The IRS provides appropriate guidelines and forms for making these estimated payments, and to manage this effectively, it's advisable to consult a tax professional. Navigating through the complexities of stock taxation isn't straightforward, which is why consulting a professional like a qualified tax advisor or certified public accountant can be invaluable. They will assist you in determining your estimated tax liabilities and ensure you comply with all applicable regulations, offering tailored guidance depending on your situation and jurisdiction. Remember to determine your tax obligations early to steer clear of penalties. Be sure to comprehend the differences between RSU taxation and share taxation. Check with your brokerage firm regarding withholding practices, and consider employing tax planning strategies to lessen your tax liability. What is the tax implication when vesting RSUs that are converted to cash in a company sale? Option A, they are not taxed. Option B, taxed as ordinary income. Option C, taxed at the capital gains rate. Option D, taxes are withheld automatically by brokerage. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that RSUs, when vested and turned into cash, are taxed as ordinary income. This taxation method is applied as they become a part of your salary or wages. To summarize our discussion, RSUs become taxable once they vest. Selling shares could lead to capital gains tax. The sale of a company could change tax timing and methods. It's important to make estimated tax payments if necessary, and seeking professional advice can simplify your tax obligations. Thank you for tuning in. If you found this video helpful, be sure to like, share, and subscribe for more informative content. Also, we'd love to hear your thoughts in the comments. Until next time, happy investing and tax strategizing.